Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden within corporate filings. And today we have a real juicy one from Blue Owl Credit Income Incorporated. We are diving into their current report filed on the 23rd of October 2025. And get this, it details a pretty significant unregistered sale of equity securities and gives us a peek into their massive offering status and portfolio update. But don't worry, we'll break it all down into plain English before we get started if you love getting straight to the point insights from these dense corpo. Rate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we chat all things finance and corporate news. So first up, they had an unregistered sale of their Class I common stock. And what that means in simple terms is they sold shares directly to certain investors without having to go through the whole public registration process with the government. This is often done for specific investment vehicles that are set up to hold the company's shares. In this case, as of early October, they sold over 4.7 million shares of Class I stock for nearly $44.5 million. This happened on the 1st of October, but the numbers were finalized on the 23rd of October. Now, this is where things get really interesting. They are currently in the middle of a massive public offering. They have a current offering where they are looking to raise up to $14 billion across Class S, Class D. And Class I common stock on top of that, they have had a follow-on offering and an initial offering, meaning they've been continuously selling shares. When you add up everything from their current public offering, past offerings, and this recent private sale, they have issued over 2.1 billion shares and have brought in over $20.6 billion in total. This is a huge amount of capital flowing into the company. Let's look at a little more detail on those shares. Class S shares brought in about $6.5 billion, Class D shares around $980 million. And their Class I shares have been the big driver with over $11.6 billion raised the private offering we just mentioned. For Class I shares added another $1.4 billion approximately, so clearly Class I shares are a major focus for their fundraising efforts. The company has a pretty neat system for setting their offering prices each month. They aim to sell shares at a price that reflects the value of their assets at the end of the previous month. So for the 1st of October, the prices were based on their net asset value per share as of the 30th of September plus any applicable sales fees for Class S. Shares, the net asset value was $9.38 and the offering price was $9.71 for Class D. It was $9.39 net asset value and $9.53 offering price. And for Class I shares, the net asset value and offering price were both around $9.41. This suggests a consistent approach to pricing across their share classes. Now let's talk about how they are funding their operations and investments. They have a significant amount of debt and they've provided a detailed breakdown as of the end of September. The revolving credit facility, for example, has a committed amount of nearly $3.8 billion and they have drawn over $1.3 billion. This is like a credit card for the company that they can use as needed. They also have a series of special purpose vehicle or SPV asset facilities. These are basically companies created to hold specific assets and secure debt against them. It's a common way for financial institutions to manage risk and leverage assets. For example, SPV asset facility. I has a total commitment of $650 million and currently has $174 million drawn. Then we see SPV Asset Facility 2 with a $2 billion commitment and $807 million drawn, and so on and so forth. This pattern repeats across several SPV facilities, showing a strategic use of these structures to finance their operations. They also have several collateralized loan obligations, or Clause C Low. XE, for instance, has a $420 million commitment and they've drawn the full amount. These are complex financial products where loans are pulled together and sold to investors in tranches. Clause are a significant part of their debt financing structure. When we look at all their debt combined from credit facilities, SPV facilities, clause, and various notes, the total debt stands at a staggering $21.6 billion. It is a massive amount of money they owe to various lenders. Interestingly, a significant chunk of their debt, $6.69 billion or about 30.9%, is unsecured fixed rate leverage. This means it is not backed by specific assets, and they pay a fixed interest rate on top of that. $5.84 billion of this unsecured debt is hedged using interest rate swaps. This is a sophisticated financial move where they essentially exchange interest rate payments to manage risk and lock in costs. Now let's shift gears to their investment portfolio. As of the 30th of September, they had debt investments in 336 different companies with a total par value of over $32.3 billion. This means they own debt in a lot of different businesses. The majority of their investments, 88.8%, are first lien debt. This is generally considered the safest type of debt a company can hold because in case of a bankruptcy, the first lien holders get paid back. First, they also have 4.7% in second lien debt, 1.4% in unsecured debt, and some preferred and common equity investments as well. A really crucial detail here is that nearly all of their debt investments, 98.7%, are at floating rates. This means the interest they earn on these investments can go up or down with market rates. This is important given the current economic climate and interest rate environment. Let's look at where their money is invested by industry. Healthcare providers and services are their biggest area of investment, accounting for 14.8% of their portfolio, or nearly $4.8 billion. Other major sectors include internet software and services with 10.8% and insurance at 8.5%. They have diversified investments across many industries with significant holdings in financial services and healthcare technology. To put their debt into perspective, the average debt to equity leverage ratio for the month leading up to the 30th of September was 0.69 times. This means for every dollar of equity they have about 69 cents of debt. This is a moderate level of leverage, not excessively high, but definitely shows they are using debt to magnify their returns. Now, looking at these numbers, Blue Owl Credit Income Incorporated is clearly a company that is actively raising capital and deploying it into a wide range of debt investments. Their strategy seems focused on generating income through lending, and they are doing it on a massive scale. The sheer volume of their offerings and debt financing is impressive, especially in the current market. The fact that most of their debt investments are floating rate could be a double-edged sword. If rates continue to rise, they could earn more, but if they fall, their income could decrease. The healthcare sector being their largest exposure presents both opportunities and risks. As with any major industry concentration, the management team appears to be very active and strategic in how they manage their capital, using various instruments like SPVs and CLOs to finance their operations and investments. The unregistered sale of equity securities suggests they are working with sophisticated investors who understand the structure and risks involved. The focus on first lien debt provides some comfort in terms of risk mitigation, but the overall debt levels are substantial. One of the main risks to consider is always the market environment and the creditworthiness of the companies they lend to. A downturn in the economy or specific industries could lead to defaults, impacting their returns. The preliminary nature of some of the data within the report also highlights that these figures could change, and investors should be cautious about placing too much reliance on them without further verification in the official filings. Overall, Blue Owl Credit Income Incorporated is a major player in the credit space. They are aggressively growing their operations and seem to be executing on a clear strategy to provide financing across various industries. While the scale of their operations is commendable, investors should always weigh the potential rewards against the inherent risks associated with leveraged investment strategies, especially in uncertain economic times. Alright, that is our breakdown of Blue Owl Credit Income Incorporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.